Investing in property is a national obsession in the UK, and any way we can make that easier for investors to achieve gives us warm feelings inside. That's why today we're talking about investing in property through REITs, real estate investment trusts, what they are, how you can invest in them, and whether they're the right type of investment for you.
The most obvious way to buy property is to save up a huge deposit of at least £20,000 to buy one house or commercial unit on a mortgage. An investment in the most popular UK REIT, on the other hand, can be achieved for about £6.50.
Knowing how to invest in property is a major gap in most investors' knowledge. And any properly diversified world portfolio should have at least some exposure to bricks and mortar. How do you get started investing in REITs? Let's check it out.
Welcome to moneyandchaplain.com, the investment channel and website that sets you and your finances free. I'm Andy, this is Ben, and if you like what we say, hit the like button and click subscribe.
And be sure to check out the offers page on moneyandshackled.com, now packed full of free cash offers like this one from LoanPad, a top Trustpilot rated peer-to-peer lending platform focusing on property loans. You get a £50 cash bonus when you open a new account and invest £1,000 for a year, and earn interest of 5%. Now, let's get into the video. Equity REITs. This episode is about equity REITs, which is the type that normal people can buy into without needing to be well connected or a millionaire. An equity REIT is a real estate investment trust. It is a company that you can buy shares in like any other that is listed on a stock exchange. It owns and operates income-producing properties. The types of property within a REIT are generally commercial property such as offices, apartment buildings, warehouses, hospitals, shopping centres and hotels.
Also, within the past 3 years, there have been a number of UK residential REITs that have been listed on the London Stock Exchange. These investment vehicles offer an easy and diversified route to investing in residential property as an alternative to buy-to-let, targeting returns of 8% plus.
How REITs make money. REITs own properties which they lease out to other businesses, collecting rent. In this way, the company generates income which is then paid out to shareholders in the form of dividends. REITs must pay out, by law, 90% of the profits that they make on property, and most will pay 100%.
How to invest in a REIT? Because equity REITs are public limited companies, you can buy shares in them just like any other company on the stock market, and there are some sweet buys out there right now. Two of our favourite UK REITs on the FTSE are British Land and Tritax Big Box. British Land is a London-centric portfolio with a 5.5% dividend, which looks sustainable, while warehouse behemoth Tritax offers a 4.5% dividend and includes as commercial clients the likes of Tesco, Unilever and even Amazon. Those massive warehouses you see on the side of motorways? Likely to be owned by Tritax.
Regular followers of moneyunshackled.com will know that we prefer to invest by ETFs where possible to maximise diversification and minimise fees. Well, you'll be pleased to know that REITs are also available in ETF form.
REIT ETFs. Exchange-traded funds are a collection of shares, usually highly diversified, that trade on the stock market very much like a company, meaning that you can buy shares in it. When you buy a share in an ETF of REITs, therefore, you are buying in one transaction into multiple REIT companies, which in turn each own multiple commercial properties. Ultra diversified property investing.
The top UK ETF for property REITs, in our opinion, is the iShares UK Property ETF, which includes, amongst many others, holdings in both British Land and Tritax REITs. iShares is, in our opinion, one of the top two providers of ETFs in the UK, alongside Vanguard, and they tend to keep fees low. This ETF has a distribution yield of 2.95% and has returned total gains on average of 8.7% per annum over the last 10 years.
As an ETF, it has an ongoing charges fee, which as a property fund is higher than a typical ETF that focuses on normal stocks at 0.4%. We assume this reflects the lower demand for REITs and the higher complexity of this type of fund. Expensive, but a price that we think is worth paying. This ETF is available on our favourite zero-fee trading apps, Freetrade and Trading 212, and you'll find links to set yourself up on these platforms on the offers page of moneyandshackled.com, linked in the description below. Use these links to get a free share on sign up.
Residential REITs. Most REITs invest in commercial properties. big office blocks and big warehouses used by big companies. A little known fact is that there are now some REITs which invest primarily in residential properties. Residential properties are houses and apartments like the one you live in, rented to ordinary people who live there and pay their rent to a property company.
As we alluded to earlier, there are now a number of UK residential REITs listed on the London Stock Exchange. These alternatives to buy-to-let property are sometimes targeting 8% plus without any of the stresses that come with being a landlord.
The Residential Secure Income REIT gives investors exposure to UK house price rises along with a steady rental income stream. Returns are passed to you, the shareholder, in the form of a target annual 5% dividend and total returns expected to exceed 8% per annum.
UK residential REITs versus buy-to-let. The returns on buy-to-let are still way better. This makes sense from an effort in, return out point of view, as buying a few quid's worth of REIT shares is far simpler than saving a £20,000 deposit, project managing a renovation and sourcing and managing tenants.
But the main two reasons why buy-to-let get better returns are leverage and the fact that they are undiversified. Let's take leverage first. Leverage. A standard buy-to-let will be financed 75% by debt, a mortgage, with the remaining 25% being a deposit from the buyer. This means that any growth in the property value will be multiplied by 4 in returns to the investor. A £100,000 rental property that grows by 2.5% in a year to £102,500 is a return of £2,500. That is a £2,500 return on the £25,000 deposit the investor actually paid for the house, a 10% return overall. And that's before rental income profits, which could easily be another 10% on top.
Interestingly, the Residential Secure Income REIT still aims for a 50-50 debt to equity ratio, meaning that your profits should still be leveraged, but in this case only by a factor of 2.
Diversification averages out returns. Diversification from a REIT means that you are getting returns from many average properties. A properly researched buy-to-let that you've put a lot of effort into setting up yourself could easily make you better than average returns. However, you have the risk that it is a single unit and therefore could return 0 rental profits when the property is empty.
Tax benefits of REITs. Tax on buy-to-lets are varied and in some ways can be manipulated to suit your personal circumstances, but REITs can have tax advantages too. REITs benefit from a benign tax regime. For example, UK REITs don't pay corporation tax or capital gains tax on their gains from a property investment. Rather, investors are taxed on the distributions as profits of a UK property business, treated as income tax rather than as a normal dividend receipt, typically taxed before you receive it.
Considering dividends from normal companies are always after corporation tax, the fact that REITs can get away with not being taxed at all before they distribute is a win for most investors. Getting started. Rewatch this video to pick up those details of the specific REIT ETFs and individual commercial and residential REITs we've reviewed, and get started adding this asset class to your own portfolio. And why not get started with a UK property ETF on a zero-fee platform like Freetrade?
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.